Good day, everyone, and a warm welcome back to the channel. Today, I'm going to break down exactly why the US dollar index continues to show remarkable strength despite weaker economic data. Right? So many traders are asking why the dollar hasn't sold off after softer CPI, a softer PPI, and early in the month we had a softer non-farm payroll numbers, right? The answer becomes much clearer once we understand the bigger macroeconomic picture, right? So I'm going to walk you through it phase by phase so that we get to understand why we are still seeing a strong dollar, right? So phase one, the war, right? The story for dollar index this year begins towards the end of February, right? If we were to look at the end of February, we're talking of this price action here. That was towards the end of February, right? As tensions between the United States and Iran escalated. So investors immediately began moving capital into traditional safe haven assets. And one of the biggest beneficiaries was the what? Was the dollar, right? So you can see here from the 97 level, right? Just gonna mark the 97 price point, which is somewhere right there, somewhere about there. All right, let's mark the proper price. So we need 97 price point, right? Right from the 97 price level, we saw DXY rally aggressively from around that level all the way to like 100. You see, we saw an aggressive rally from 97 to 100, right? 100.50, which became a resistance level, right? I'm also going to mark that out right here. So we're talking of 150. Of course, here it's like 100.54, but I'm just going to use a institutional price point, which was 100.50. However, that rally eventually ran into that major resistance around the 100.5. This level became extremely significant because every attempt to push higher has been rejected. Every attempt to push higher has been rejected, meaning it's a very strong area of what? Of resistance. At this stage, buyers were willing to defend the dollar, meaning we were in a bullish momentum, we were in a bullish bias. So every retracement, every reaccumulation into discount presented opportunities for you to be a what? A buyer, right? So buyers were willing to defend the dollar, but they simply did not have enough conviction to establish a sustained breakout, right? We're talking of this price level here when dollar went towards 100.50. That resistance would later become one of the most important levels on the chart because price found resistance. Now, moving into mid-May and early July, moving into mid-May and early June, the market entered a period of consolidation right here. The market entered a level of consolidation. Price traded inside a relatively tight range, approximately between 99.40, right? 99.40 and 99.90. We had a big tight consolidation range there. Now, this wasn't random price action, right? Let me mark 99.40. You can do the same on your charts so that you get the clear price points. So we've got 99.40, right? And we also have 99.90, right? You can see there, that's our consolidation right here. There was a big consolidation. Now you can see clearly the consolidation if you go to, say, the daily chart. Mid-May, somewhere around mid-May and early June, right? We're talking of this level here all the way to 99. That was a big consolidation right here, right? That was our big tight consolidation. This wasn't random price action. It reflected two opposing macroeconomic forces battling for what? For control. On one side, we had dollar negative developments, right? Markets became optimistic about a possible US-China trade agreement, awaiting Trump's approval during that time. At the same time, Treasury yields began easing, while oil prices also softened. All of these developments typically weaken the dollar index, right? But on the opposite side, right, the other factor, stronger inflation data through core CPI and PPI, that was mid-May and beginning of June, together with a stronger than expected non-farm payroll report for June. It reinforced expectations that the Federal Reserve will maintain a more hawkish monetary policy. Now, these opposing forces effectively cancelled each other out. Instead of trending, the market simply moved sideways while waiting for a stronger catalyst, right? So the consolidation was moving sideways and everything, and we were just waiting for a stronger catalyst. Now, in phase 3, right? So phase 2 was the consolidation. Phase 1 was the Iran war. Phase 2 was the consolidation that we saw mid-May until early June. Phase 3, enter Warsh, right? The new Fed chairman, right? So I'm gonna call this the Warsh catalyst, right? That catalyst finally arrived on June 17, right? This was arguably the most important event in the entire move, right? Kevin Warsh chaired his first FOMC meeting, and markets were expecting a much more dovish Federal Reserve, right? Instead, we received the exact opposite, right? And the new chairman came in and placed strong emphasis on price stability. The Federal Reserve removed its unique forward guidance. The Federal Reserve removed its forward guidance. The new chairman chose not to submit his own interest rate projections. So now this goes back if you watched Warsh first press conference. And most importantly, right, during that FOMC, 9 out of 18 participants projected rate hike in 2026, compared with none back in March on Powell's last FOMC meeting, right? That completely changed market expectations, right? So from the consolidation, boom, we had another expansion, because now we're looking at a hawkish fade, right? Immediately afterwards, the 2-year Treasury yield surged by approximately 14 basis points, if I'm not mistaken. So we're talking of the 2-year Treasury yields. You can go onto the 2-year charts and see to that. Let's see. Let's open the chart quickly. And FYI, guys, that the 2-year yield chart is very important. You need to be in a position to look at it and analyze and understand what's happening. You can see there, mid-June, that's when we had Warsh first FOMC meeting, and boom, there was a big surge to the upside. So the 2-year yield surged big time, right? Markets interpreted this as a significant shift in Federal Reserve's policy stance, right? We're gonna go back to DXY. The result was exactly what we saw on the chart. DXY finally broke above the long-standing 100.50 resistance. You can see here, we eventually broke to the upside. This was a very strong resistance level with conviction and established itself above 101, right? The breakout was confirmed. Now phase 4 comes into the picture, right? Which is why DXY is still holding to the upside, right? Let's look at what's happening today. Over the past couple of weeks, there's been several pieces of softer US economic data, starting with the NFP early July. Consumer inflation came in below expectations. That was last week. Producer inflation also missed focus. That was last week. PPI. Normally, this combination should put significant downward pressure on DXY, but that's not the case. That hasn't happened because markets are currently focusing on two much stronger themes, right? The first is renewed geopolitical tensions involving Iran. Every escalation, guys, increases demand for safe haven assets while also creating concern around higher energy prices. You can see today the opening of Brent opened way up. You can see Brent has resumed its what uptrend trajectory. This is only going to result in higher energy prices, and that's not good because in turn it affects inflation, right? So that's the first geopolitical risk, right? The second one is Federal Reserve hawkishness, right? Kevin Warsh's continued hawkish messaging, even outside the FOMC meeting, including during this ECB forum that was held recently. Warsh continued stressing the importance of restoring what? Price stability, which is the Fed's mandate. He can go on and on, but that's their mandate. He also aligned himself with other major central banks, governors, in moving away from relying on forward guidance, right? So take note, guys, we no longer have forward guidance, right? So in other words, the Federal Reserve is still communicating a higher for longer interest rate environment. That narrative is proving more powerful than weaker economic data. Instead of DXY collapsing, it is simply absorbing the negative news through relative shallow pullbacks, relative shallow retracements, relative shallow reaccumulations, right? From a price action perspective, that's a sign of underlying strength, right? Another thing you have to consider, right, is the 2-year Treasury note futures, right? It can help you in confirming the story using the bond market. Remember, we have the yields, and then we also have the bond market. So this is the 2-year Treasury note, and this is the 5-year Treasury note. Then we have the 10-year Treasury note, right? If we look at the 2-year, Treasury note, we can see they've been trending lower since March, right there. That's March 2026, and you can see how price has been trending lower to the downside. On MWD, on monthly, price is bearish. Now remember, when bond prices fall, yields rises, right? When bond prices are trading lower, the yields, they're going to trade higher. Rising yields generally support a stronger US dollar because they increase the return investors receive from holding dollar denominated assets. So the bond market is telling exactly the same story as the currency market. Despite softer economic release, investors continue pricing in a more hawkish Federal Reserve. So as long as that remains the dominant narrative, higher Treasury yields should continue providing support for the US dollar, right? So in conclusion, or to summarize, right, the current strength in DXY isn't being driven by economic data alone, right? It's being supported by 4 major factors. Number 1, geopolitical tensions have created a sustained safe haven demand for dollar index. The 100.50 resistance breakout confirmed a major shift in market structure, right? I'm on the monthly chart. I'm just going to go to the weekly quickly. You see, we broke out of the 100.50. That's a major shift in market structure. We basically have boom, 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 market now trending to the upside. So you'll be looking for areas like this, inefficiency right there, right? That's on the weekly chart. If you go to the monthly, let's go to the monthly chart. We are looking at this whole inefficiency here as the draw on liquidity. You see, draw on liquidity, meaning price will look to trade to the upside. Number 3, Kevin's Warsh unexpectedly hawkish Federal Reserve has fundamentally changed interest rate expectations, right? Number 4, rising Treasury yields continue to validate the strength we are seeing in the dollar index, right? So until those underlying drivers begin to change, temporary weakness from a softer economic data is likely to remain limited. So yeah, that's pretty much what I wanted to share with you guys. Of course, there's not like a whole technical analysis detail on the chart, but more of a macro perspective outlook that you have to know, that you have to understand when you're looking at dollar index. So yeah, thank you for watching, and if you found this analysis valuable, be sure to like, subscribe, and I'll see you in the next market breakdown. Thank you.